Hello, Chris. Well, I know you're on a tight time frame. Chris has to get out in half an hour, Tony, by 4:30, so we've got to get into it.
No problems. Well, thanks for coming on, Chris.
No, pleasure. Thanks for the invitation. It's great.
Yeah, well, I've known you for a long time, although you probably haven't known me, but I've been a long-term shareholder in WAM Capital.
Good. Okay.
Yeah, right back to the early days when Jeff Wilson used to come to our meetings, and there was about 10 of us in the audience, I think.
What year did you invest at the start, in 1999 or?
Yes, I think it was after the first results came out, the first half-year results.
Wow, there you go. Fantastic. Are you still own them today, or have you sold out?
I've bought in and sold out along the way, tending to trade them when the discount gets enough to the NTA. But I still keep a very small amount just to keep the comms going, which is great.
Oh, good one. Yeah, very good. Good to hear.
So before we get too far into this, we should explain who Chris is for people who are tuning in. Chris runs 1850. Is that how you say 1851 Capital, Chris?
Yeah, correct. That's right, Cameron.
1851 Capital. You've been around about a year, I think. Is that right?
Yes, 14 months now. So we launched it in February of last year, 2020.
And you were previously with Wilson Asset Management, hence Tony's comments about WAM. You launched at an auspicious time, Chris. You like to plan things very carefully. I see. You launched just in time for COVID. How did that feel?
No, it felt great. But when we launched it, then obviously the world changed 4 weeks into launching a business. So we feel like we've had the kitchen sink thrown at us in our first 14 months, but pleased to say we've come through the other side. In fact, some people have commented it to us and said actually the timing turned out to be quite fruitful given the performance you've had in your first year or so and the growth in the funds under management. So it didn't feel good at the time. Don't worry about that. It felt like going through the GFC all over again in the space of 3 or 4 weeks. No, pleased to say we're in good shape now.
It reminds me of when Magellan was launched. I'm pretty sure that was back at the depths of the GFC as well.
Yes, it was. And we were told by a few people through that period that some of the best fund managers have launched, just before various crises over the years. And so we thought they were just being nice to us. But in fact, you're right, Magellan and others, in fact, have done that over time. Now,
on the background, I can see 1851 Capital. Is that why 1851? Is that a score or is that a year?
It's a year. So the year 1851 in Australian history was a prominent year in Australian history. It was the start of a period of wealth and prosperity where the gold rushes kick off that year with the Eureka Stockade. Only a few years after that, in fact, the decade after the year 1851 was a really strong period of economic growth, for Australia. So, we wanted to have a number in the name, so that was as good as any.
That was when the gold rush started, wasn't it?
It was, in fact, yes, in Orange, New South Wales. So a very, very, as I said, it commenced a very strong period of economic growth here in Australia for many, many years after that.
So does that mean you're investing heavily in Bitcoin then, Chris, to the new digital gold?
No Bitcoin for us. We focus on investing in small cap growth companies primarily listed on the ASX here in Australia, and that's where we've spent a lot of our time over the last 10 or 15 years is looking for those growth companies in that small to micro cap in the market, which has certainly been, we think, a very fruitful part of the market to generate strong levels of alpha over a long time period, and we think that remains the case today.
Yeah, interesting. Do you find the small caps cyclical though? Do you find that sometimes they outperform large caps and sometimes they underperform large caps?
That's absolutely the case. And what we've found over the years is we pride ourselves on finding those companies that are growing no matter what the economy is doing. So an example would be Corporate Travel Management, which listed at $1 a share in 2010. For the following 10 years for that business, the corporate travel sector in Australia was flat. So corporate travel share price has gone from $1 to north of $20. In fact, almost got to $30 the peak pre-COVID. And that's been on the backdrop of a flat corporate travel market. So they've been able to grow their earnings by taking market share, obviously, but also growing via M&A, expanding to various parts of the world, Asia, Europe, and the US. So they're the type of companies that we like to find, those early stage small caps that go on to be market darlings, and in some cases, like Afterpay, go on to be an ASX top 20 company. So at Afterpay, we were one of the largest investors at the IPO for Afterpay and sold them too early, like a lot of other people, I suspect, given the run it's had. But that's typically just gives you a bit of insight as to what we are trying to achieve and what we are looking for.
Gee, that begs so many questions, Chris. So just the Afterpay example, I guess, its PE is around 100 now or thereabouts. So are you saying you won't hold something when it gets up to that kind of lofty valuation?
Yeah, look, we certainly, we've got a price target or a valuation on every stock in the portfolio. And the beautiful thing for us is that we come in with a fresh set of eyes every day. And if a stock hits that price target or our valuation target, then we'll certainly not be hesitant to exit it from the portfolio and move on to the next one. So we're very, very strict with that criteria. In fact, it's one of the lessons that we've learned over the years is that we sell our positions too early. So we're typically early buyers and early sellers of companies. So we look for, as I said, those early stage businesses with no institutional shareholders on the register, no stockbroker coverage, passes the Sunday barbecue test where you mention the name of the company and no one's ever heard of it. They're the companies that are right in our sweet spot. And when they typically go on to be much bigger and more wonderful businesses, whether it be an A2 Milk, a Magellan, or an Afterpay, some of those companies that we've ridden the wave with over the years, is that we typically look to exit those companies when they hit our price targets and become just what we call discovered stories, where you've seen a lot of fund managers come on the share register. There might be 5 or 10 different research reports from stockbrokers around town. So they're typically some of the things that we look for and identify in some of those early stage small cap businesses.
So I guess that sort of answers my next question, which is going to be, how do you solve for liquidity? I guess your exits are helped by the fact that the company's grown so much that there's liquidity.
Yeah, and look, it's a really good question. Liquidity is so important. Being through the GFC and now the COVID crash of last year, liquidity is critical in this end of the market, and that's small to micro cap end of the market. Because things go wrong, and you've really got to have the ability to be flexible and be nimble, and to be move around in your positions in the portfolio is critical. And we had a good another reminder of that last year, going through that March period, where some of the stocks on the small cap market fell by 70 or 80% in the space of 3 or 4 weeks. Extraordinary falls in such a short period of time. So liquidity is really big for us, and it really flows through to our stated fund capacity, which is 400 million, and limiting the size of the 1851 Emerging Companies Fund that we manage is really, really important to us. And we think by limiting the size of the fund gives us the best possible chance to generate significant levels of alpha or outperformance over time. Because our strong belief is that as you get bigger as a fund manager, as you take on more assets under management in this end of the market, in that small to micro cap end of the market, it becomes, let's say, a lot harder to outperform. And a lot of that comes down to your question around liquidity and your ability to be flexible and nimble and move around on a day-to-day basis.
So does that mean you'll close it to investors at 400 million, or will you open up a new fund if the fund grows to be 400 million?
So there's no current intention to launch any new products. In fact, funds under management today sits at 250 million. When we get to 300 million, we're going to put the final call out to any prospective new investors who might want to invest in the fund before we soft close it off. So soft close means closed to any new investors. And the reason for that is we don't want to break through that 400 million mark significantly. We've had almost 100 million of net inflows into the fund over the last 6 months. So we're in a strong position. We've seen significant momentum from an inflow perspective, particularly in the last few months on the back of our strong 1-year performance. So once we reach that $300 million mark, we'll put out the call to our subscribers on our website to say that the fund will soft close in a month's time, and then we'll look to review it down the track as to whether we reopen it from time to time. But it's very important that we limit the size of the fund.
I understand you had a good 1-year performance. So if you have that performance again, now you have to close the fund down straight away, wouldn't you?
That's right. So we're up 100% after all fees and expenses over the last 12 months. And I can quite confidently say that we won't achieve that return again in the next 12 months. Certainly a remarkable period, hasn't it been? And a great period for investors that have been in the market over the last 12 months. Some of the savvy ones that certainly bought into the market or bought into our fund back in March of 2020 have certainly done well.
Yeah, that's great. So what kind of process do you have? What kind of investor would you call yourself other than a small cap investor?
So we're an active bottom-up stock picker. So we hold a fairly diversified portfolio, around 60 to 70 positions at the moment, which sounds like a lot, but we're totally index unaware. So in terms of, we do not typically track the index so much, even though we do have a high level of positions in the portfolio, and that's really given that a large part of our positions in the portfolio don't sit in our benchmark, being the Small Ordinaries Index. We focus on that X100 part of the market in Australia, down to 50 mil market cap. When you strip out resources, which we don't invest in biotech companies. Our investable universe sits around that 600 companies that we look to potentially invest in and visit from time to time. We visit over 600 or 700 companies a year in our process. Both Martin and I, as the portfolio managers, are very active in terms of meeting with companies. In fact, we've become experts, like a lot of us, in Zoom and Microsoft Teams over the last 12 months, speaking to companies, virtually, but we are starting to see that revert back to normal now, where we can meet companies face to face, which is great. So in terms of our process, we shrink that universe down to 600 companies. We meet with, as I said, 600 or 700 a year, and many we meet, a few different times throughout the year, particularly the ones that we own in the portfolio. So we're looking for companies that are growth companies, typically growing at around 2 times their PE or price to earnings ratio. So it could be a company growing at 30% on a PE of 15 that would fit our criteria. And so we typically find they are in those growth companies in that smaller micro cap space. So we're essentially looking at the same part of the market that we've looked at for almost 15 years, going back to our history in the funds management industry.
So would that be a trigger for a sell then, if you had a company that was growing at twice PE but then started to slow down?
Yeah, no, it would. And certainly, as I said earlier, every stock in the portfolio has got a strict valuation or a price target on it, which we have in place. And if any time or any day of the week we come into work and that stock hits that price target, we'll look to sell it and move on to the next one. But certainly it's been a very fruitful period for investors over the last 12 months. We've been spoilt for choice as fund managers, where we've had too many things to invest in. We can't fit them all in the portfolio, and that's certainly a feeling that we haven't had since 2009, coming out of the GFC, where the market bottomed in March of 2009. That 6 to 9 month period coming out of that was a similar feeling, where we had too many ideas and couldn't fit them all in the portfolio. That's very, very unusual occurrence, and something we don't see very often. In fact, it's normally the other way, where you can't find enough companies that fit your strict criteria in your process to fit in the portfolio. So that partially also explains that the higher stock numbers at the moment being around that 65 to 70 mark versus that 30 to 80 range that we talk about in our investment memorandum.
Yeah, I must admit, I agree with you about coming out of the GFC. It did have the same feel about it last year. Do you find that you start to track the index more when you hold a bigger portfolio? No,
we don't. In fact, it's quite the opposite, given that a lot of we're totally index unaware. So if you look at the top 10 components of the Small Ordinaries benchmark, which we use as our benchmark, being X100 investor, we don't own a single one of those top 10 stocks. So we're very much index unaware. A lot of the companies, a third of the portfolio would be what we call invested in the micro cap sector, which are companies below 300 million in market cap, as we define it. So we don't tend to find that we have a very high correlation with the benchmark. In fact, it's quite the opposite. So we're really pure bottom-up stock pickers, looking for those growth companies that are going to go on to be the next Magellan or A2 over time.
So the fact that you're holding 60 or 70 companies in your portfolio, is that more a factor of liquidity, like you don't want to take a large position in a very small company?
Yes, it's a good point you raise, and that comes back to that discussion around liquidity earlier, which I failed to mention, is that we like to run diversified portfolios, not putting all our eggs in one basket. Things inevitably go wrong. We make mistakes as investors, as we all do, and we learn from those mistakes. And having a diversified portfolio protects you to an extent. It is a good risk mitigation tool in terms of managing that risk profile of the portfolio over time. So certainly for companies that are on that lower end of the spectrum in terms of market cap, whether it be between that maybe 50 to 100 mil market cap range, you might see us only have a 0.5% position in the portfolio. Typically our starting point's 1% position in the portfolio for a new stock that comes in, but For those smaller illiquid positions, we tend to have a smaller weighting in the portfolio. And just to give you a sense of the underlying liquidity in the portfolio, within 5 business days, we could go to 45% cash in our portfolio. So that assumes 20% of the average daily traded volume, which is quite conservative. So, I mean, it's really important to us is that we run even though we are invested in we're deemed to be in a relatively liquid part of the market, being that small micro cap end of the market, is that we focus a lot on companies that are high level of free float and high level of turnover, which gives us the flexibility to move around if the need arises.
Yeah, good. So meeting with 2 companies a day, basically every day of the year, sounds like a lot of hard work. I know from my experience at company presentations and small group meetings with CEOs, etc., that they're very good at selling you on the good story that they've got. So what do you look for when you're meeting with a company that might sort of get to the truth?
Well, it's a good question, and companies have certainly perfected that art, haven't they, over the years in terms of pitching and presenting their company in the best possible light. Some of the key things that we look for, firstly, is good skin in the game. So the actual equity ownership of the management team and the board itself. And for corporate travel management, which I talked about earlier, Jamie Ferros, the founder, floated the IPO of the company in 2010 and still had around a 30% stake in the company himself. And he sold down that position. I think he sits around 15% today, but he sold that down over the last 10 years at much higher prices as he goes. So that is certainly a really important thing for us, is that particularly the management have got good skin in the game, and when they're buying and selling shares on market as well, that's obviously a really strong indicator, we believe, based on our research. Whether they're buying or selling is a really good lead indicator for what that share price could potentially do over the following 1 to 2 years. So that's a really important factor. One key factor that's also come up for us in a lot of our successful investments over the last decade or 15 years, some of our most successful ones have typically got a net cash balance sheet, so no debt. And they've done that through a number of different ways. Firstly, just generating that cash organically, so a high level of free cash flow, sitting on the balance sheet, which they've accumulated over a few years or many, many years. And what we found is that having net cash on the balance sheet gives those companies optionality over time, whether it be to make acquisitions, to grow earnings that way, from a capital management perspective, share buybacks, higher dividend yields or higher payout ratios over time. So we've found that that's been a really strong indicator for us in terms of the successful investment we've had well over the last 15 years. So that's a really important factor that we look at as well. And clearly industry structure, like everybody does, but we compare, say, a retailer with low barriers to entry. They're very, very hard to make money into retail business, although the last 12 months has probably been the best year to be in retail for almost 30 or 40 years. As well as comparing that to businesses that have got really strong, I don't like using the word moat, but a competitive advantage, which really differentiate themselves and high barriers to entry to stop any new entrants coming in to compete.
I guess things like an owner-founder, PE over growth or growth over PE, and lots of cash is you're describing some of the elements on my checklist when I invest, but I don't need to go and talk to 200 or 300 people a year to pull the trigger. What extra value do you get from the face-to-face meetings?
Quite a lot. So we typically ask the same questions of the company every time we meet with them. And it's fascinating, years ago, ABC Learning Centres, which was listed on the ASX, very successful, pre the GFC, and then the company grew too quickly and essentially went broke. And we had a position at Wilson Asset Management ABC Learning Centres going back to 2005, 2006, and working with Matthew Kibben at the time. Matthew would ask Eddie Groves, the CEO, the same question every time: and what's the occupancy level of your centres? And the reason why he did that was because the CEO, Eddie Groves, had told him previously is that, Matthew, that's the one question you've got to ask me every time you meet. It's a key indication of how the business is going. So every time we'd meet with Eddie, we'd ask him the same question. And then 2 years down the track, we'd ask Eddie, so Eddie, what's your occupancy levels running at? And he goes, no, you don't have to worry about that anymore. It's not relevant. We're a much bigger business these days. We're expanding. We're over in the US. We've got a much bigger presence in Australia. We're looking at the UK as well. And to us, that was a red flag. That the story had shifted, the story had changed, the strategy had changed. McPherson's was another one last year where we experienced that, where the strategy changed dramatically. And since then, the share price has halved. We've seen the CEO depart. So that just gives you a bit of insight when we meet with these companies. There's only so many questions you can ask them. You've got to be really careful what you ask them, make sure it's all public information. Is that it's really critical, and it's shown over time for us is that asking those same questions, making sure the company's staying to their stated strategy and plan to grow is really important. And so it's a really important part of our process, particularly in the last 10 years. What we've noticed is the quantity of sell-side broker research in our market, the smaller micro-cap end of the market, has declined dramatically. In fact, I'd guess that it's halved in terms of the quantity of reports that we see. So it's more important than ever for us and people like us to get out there and meet with the companies, as they say, wear out the shoe leather and meet these companies face to face and build a relationship and try and understand more about the business and learn more about the business every time we meet them.
Yeah, that's interesting. That certainly was a feature of Wilson Asset Management. Are you adopting the same style as you use there, or what have you learned that you've taken with you, and what have you learned that you've left behind in
so different? So it's slightly different. So a few things. Firstly, the 1851 Capital Emerging Companies Fund is a long-only product, so we don't short sell. Now, we could short sell at Wilson Asset Management. It was never a big part of what we did. In fact, the 10 years I was running the portfolios there was maximum 5% exposure on the short side at any one particular point in time. And what we found is we're no good at short selling. We ran the numbers over 5 years. In fact, we broke even on our shorts. So let's take that off the table and not invest in any, well, let's not short sell any companies. Secondly, we don't invest in unlisted companies, which WAM do in a very small way. Again, coming back to that discussion around liquidity, that's really important to us. So it's important that we stick to ASX listed securities and don't invest in the pre-IPO market, which we think is quite hot at the moment. It's certainly rife for a correction in that pre-IPO market, we think, over the next year or so. And the final piece would be our cash. So we don't hold as much cash as the team at Wilson Asset Management do. In fact, when I was there over 10 years, WAM Capital had an average cash position of 34% over 10 years. Our philosophy is that at 1851 Capital is that people invest money in the fund to get exposure to the market. If they want to be in cash, they'll generally make that asset allocation decision themselves and put it elsewhere. So our average cash position at 1851 Capital has been around that 5% mark over the last 9 months in particular, which is more broadly, we see as fully invested. It's always good to have a little bit of cash up your sleeve for a rainy day. If we have a correction in the market, capital raisings pop up. So there's always opportunities that pop up. So it's good to have a bit of cash there to take advantage of those when those opportunities arise.
Yeah, look, it's always been something that I've questioned Wilson Asset Management on, is if you're holding so much cash, but you're still achieving 17% per annum, you could be doing 18, 19, 20% if you're fully invested, which provides you the buffer you're looking for when the bad time comes. That's
very true, but also what we found is that holding a high level of cash protection on the downside as well. So there, through the GFC, we found that holding high level of cash certainly helped preserve capital. So it's a really important risk mitigation tool, is being able to have flexibility around that cash weighting. But certainly we feel as though the mandate we've got at 1851 Capital, we say we average no more than 20% cash over time, gives us the flexibility to go above 20%, but I don't expect that we will at many occasions in the future, given our philosophy. And we believe that we want to be more fully invested, not over time. And so certainly, Martin and I are collectively the biggest investors in the fund, so we've got good skin in the game, so to speak. So we want to be more fully invested and have our money working as hard as possible.
Yeah, no, I understand that. Are you talking about cash, and it was one of the intriguing things watching Jeff Wilson go to cash and go from cash, because it was a good indicator of where the market is. Are you market agnostic in terms of your process, or do you have a view on where the market is and where it's going?
No, we're a bit agnostic, so we've got flexibility to move it around. But in terms of our current view on the market, we've been saying over the last 6 months we're the most bullish we've been since the GFC. We think the backdrop at the moment of easy fiscal and monetary policy is not going away anytime soon. The RBA have told us here in Australia that interest rates remain on hold till at least the year 2024. So we think that certainly provides a good runway for equities. You typically find equities do outperform in lower interest rate environments, and that's proven to be the case so far this cycle, which we think commenced in March of last year. We've also got that attitude of central banks and governments around the world of doing whatever it takes to stimulate their various economies. That continues. We've seen it more recently again domestically with Josh Frydenberg, the Treasurer, announcing a $1.2 billion stimulus package for the travel industry. So we think that coming out of this awful COVID pandemic, that we will continue to see really strong returns. In fact, based on the discussions we're having with companies and what we're observing, is that the economy looks in the best shape it's been in well over 10 years. And in fact, what we think we'll see over the next 12 months is some of the best economic data or prints that we've seen for many, many years, if not decades. And we've started to see it already. The unemployment rate back at 5.6% already. Consumer confidence is at a 10-year high. The banks are lending again. House prices are motoring higher very, very quickly. So it's hard not to be bearish. Now, we know the market can't keep going up in a straight line, and inevitably it will correct and come back. But we think that the direction over the next 2 to 3 years certainly remains, it goes higher from here, and then the bullish, the backdrop for the market looks as bullish as we've ever seen.
It's interesting, isn't it? I mean, I don't want to make a too big a deal of this, but when the right level of welfare payment is made during a crisis and interest rates are set properly, the economy booms. It kind of answers a political debate that's been going on for a long time about welfare and about supporting people back to work and things like that, doesn't it?
Yeah, and it's been interesting. People are fearful about the fiscal cliff. So what happens with our economy when all the stimulus finishes, particularly JobKeeper, which has finished only a few weeks ago. But what we've seen is that back in October of last year, we had our fiscal cliff at that point where the amount of stimulus in the system shrunk by 80%. That was primarily driven by the JobKeeper payments falling from September to October. The amount that was paid went from $1,500 a fortnight down to $1,200. The amount of people participating in that program dropped a lot. So what we saw is that period is that the stimulus came down, but the economic data continued to accelerate to the upside. So we think that we don't have any fears around JobKeeper finishing only a few weeks ago. We think that the backdrop remains strong for the economy, but we certainly think that this bull market, which commenced in the March of last year, it feels a lot like now we're in 2010 compared to coming out of GFC, where a lot of the easy money is being made coming out through that mid to late 2009 period, and now we're hopefully in a return to more normal conditions where the share market could rise anywhere from 5 or 10% per annum, like it's done for the last 50 or so years.
Yeah, no, I agree.
Probably, sorry, Tony, we've probably got time for one more question, and then we'll have to let Chris go.
All right, thanks, Cam. Yeah, Chris, if people want to invest with you, how do they go about doing it?
So the best way is to jump on our website, 1851capital.com.au. The application forms are on the homepage, and please fill out those forms. Contact the office if you have any issues completing those forms, but you can send those off to our administrator, Mainstream, who do the administration. We outsource our administration to them, but certainly with the fund sitting at $250 million today, we expect that we'll be soft closing the fund over the next few months to new investors. So pleased to say we're in a strong position in that regard.
All right. Well, I'll leave it at that, Cam, unless you have other questions. But good luck. It's great to hear you off by yourself, and it's been fun and interesting watching your career. So I'm sure you'll do well.
Thanks, Cameron, Tony. Appreciate your time today.